Hey everyone, in this video we're going to be talking about debt. So why is debt so important in M&A? Well, there's really three key reasons. So number one, debt impacts the valuation of businesses, i.e. it's a factor of net debt. And if you recall from M&A 101, and specifically we did a whole video around net debt, which I'll add to this mini-series, which is that in order to calculate how much you pay for a business, i.e. a valuation, you need to calculate enterprise value, which is the value of the business on a debt-free, cash-free basis, but you also need to calculate what the equity value of the business is, as that's the actual amount you're going to end up paying for a business. All right? So enterprise value is typically a multiple of EBITDA, but it could equally be a multiple of EBIT, revenue, gross margin, net revenue, or DCF valuation, but most commonly it's valuation of EBITDA. To get to equity value, however, if a business has debt on the balance sheet, and this could be bank debt most obviously, but it could also include things like debt and debt-like items, could be kind of things which are kind of in the gray area, like for example tax provisions or excessive leave, etc. But yeah, we'll cover that again, we'll add that video again, but I mean, that's the first thing as to why debt is important. We need to remember that any debt that we bring on the balance sheet of a business is going to reduce the value of a business when it comes to exit and also entrance. So secondly is debt is a key driver of returns for private equity / VC investments. And we've gone through this in our LBO modeling video session, but essentially we'll do a refresh of this a little bit later, but at its most simple, at its most simplest, essentially equity investment, private equity investment, which includes venture capital and private equity, is essentially just how much money are you putting in the business and how much money are you getting out at exit. And how much money we put in the business, we can actually reduce that by using someone else's money, i.e. debt. So that's going to actually drive returns. So get a better money multiple and better IRR. That's the second reason why debt's so important. And the third reason is debt can be used as a lever for funding timing and amount. So I'll give you two examples there. So number one, funds like venture capital fund, private equity funds, they'll often use debt funding to drive returns simply as a timing mechanism. And what I mean is, we're not talking about the second line here where a private equity company, instead of putting in 10 million of equity, they'll just put in 5 and put the rest in debt. What I'm talking about is a situation where the fund is always going to put $10 million of equity in, but really what they're doing is they're borrowing money on a fund bridge facility for, call it 12, 18 months. And after that, they'll do a capital call, which basically means draw money from their investors and then inject the equity by essentially paying down the debt at that point in time. So the reason funds will do that is because they've still got the investment day one on bridge loan facility, but it means that the clock on their IRR at the fund level, which is basically how carry is calculated, which is basically their share of proceeds, only starts when they actually call the capital from investors. It doesn't start when they borrow money. It only starts from when they call money from investors. So it's really just a timing issue. But the second way this can be used is, let's say a fund has a $500 million fund and it's allocated $50 million to 10 different investments. Debt can actually be used to actually increase the amount of funding behind that investment. And maybe they want to use that for acquisitions or other growth opportunities. Let's say the fund puts in 50 million of this business into this business. They then deploy that in acquiring businesses, and now the EBITDA has grown. What the business can now do, because they've got all this new EBITDA, is they can then go to the banks and refinance and get a much larger debt facility. So they can actually increase the amount from 50 million and maybe get another 50 million of debt financing as a result of that. So actually they're turning that 50 mil into 100 mil at the company level, simply because the private equity has fully deployed all of its capital. So those are really kind of the three reasons why debt is so important in investing. I guess there's a fourth one, which I've actually included in benefits of debt investments, but you could argue as a fourth reason why debt's so important, is you can actually use debt to do dividend recaps, which is essentially, we've got a slide later on what this actually means, but essentially a dividend recap is when you actually borrow money in the company and you pay out a dividend back to the investors. So it's a common private equity and venture capital move. And it basically allows the company to secure an investment. So let's say an investment they've put in $50 million to buy this investment. And it could be either the company's grown to $100 million, or maybe they just want to do a day one dividend recap. And basically what happens is they'll then put debt into the company. So let's say they get $25 million of debt and then pay that money as a dividend out to shareholders. So let's say the private equity firm then gets $25 million back. So that means theoretically they've put $50 million in the business, but then they've got $25 million realized already. So now they can show to investors, this is still a 1 times multiple on investment deal, but we've realized half of that. So it's also it's basically a good way of locking in returns. So you never know if an investment's going to go to zero, for example, but if you've already realized half of it, that way you know that you've locked in half the returns, and the rest of it, the 0.5 times unrealized, you can always increase that and grow the business and sell it for a higher return later, but you can't go below 0.5 times at that point in time. So it's just a way of kind of guaranteeing returns. But let's talk about now what are the downsides and the benefits of debt investment. So, obviously with debt, it's not a risk-free thing to do like it is with equity. With debt, you have to pay interest rates, right? You have to repay some of the principal sometimes. So there's additional risk. So what happens if, the business's cash flow goes down, it can no longer service the loan? Then the bank could actually take the keys to the business, which could be a really good business, but at the end of the day, the bank will say, well, you missed this one payment, therefore I'm going to take control of the business. And therefore, as a private equity investor, your investment goes to zero. The other issue is interest rates, and we've typically invested in businesses at 0% interest rate, or close to 0% for the last 10 years, but we're actually going to a higher interest rate environment. So, have you factor that in? And, interest rates might be low now. You might be paying 4 or 5% on your loan now. But what about in 2-3 years' time? It might be at 10%. And then all of a sudden, the business can't actually service its loan, and similar situation, the bank takes the keys to the business, which is, far from ideal. The next is compliance. So it adds a level of kind of, administration and also risk here as well. So typically what happens is a bank will lend you the money, but only on certain conditions, so that, the business is still performing well, that you're not doing anything wrong, like, taking money out of the business or acquiring the wrong assets or using the debt for a different purpose to what you agreed, or perhaps leveraging up the business even higher than what the bank has agreed to. So what happens is the company typically needs to report to the bank on certain criteria set by the bank when they take out the loan, and these are called covenants. It's typically a leverage ratio, which is essentially, basically you can't borrow more than X times EBITDA. And this has dual purpose. Number one, if EBITDA in the business crashes because it's underperforming, that's going to be a breach of covenant, and therefore the bank has a right to, it's getting the numbers regularly, so it knows when that happens. But also, if it does happen, the bank can take the keys to the business. Secondly, even if EBITDA is flat, it prevents the business from then going and taking out debt elsewhere because there's a maximum leverage ratio. So if your bank lends you 3 times EBITDA, and then that business goes to another bank and says, can you lend me another 2 times EBITDA? The business would now be at 5 times leverage. So having a leverage covenant prevents that. There are other covenants like serviceability, etc., but leverage is typically the key one. So yeah, downsides there because there's risk. The bank could take the keys, and also the administration side as well. And let's say, maybe your business, you're expecting a couple of quarters down because of COVID or whatnot, and it's just a short-term blip on the radar, and long-term it's good growth prospects. By having covenants in the building, it really takes away that flexibility in the business, which you could otherwise have if you didn't have the covenant and debt in place. Next is the complexity. So there's a number of different debt products. There's cost associated with implementing those and understanding those and agreeing the terms, right? So there's a lot of complexity, and that brings risk and cost. And finally, the other key downside of debt is the potential pushback from founders. So often what happens is private equity and even venture capital often have bad reputations. Typically it's private equity because founders who own their business outright, they're hesitant to sell to private equity because they heard bad stories about private equity in the US and Europe buying a business, cutting costs, which means firing people, and cutting out things like Christmas parties and subscriptions and other things just to make money, which the staff aren't very happy about. Then putting debt in the business, which of course is going to drive returns for the fund investor, but it adds a huge risk to the business and sucks up free cash flow just to paying it, right? So the last thing you'd want as a founder is some private equity firm coming along, cutting costs, adding all this debt, and then realizing that they can't service the debt, and then the bank taking the keys to your business or your business going bankrupt. As a founder, you have a reputation, you have like your business that you've created as a founder, it's like a baby to you. So if someone is adding a huge amount of risk into it all of a sudden, stripping it out, this is not ideal. So often there's pushback from founders from this or other shareholders in the business because they're saying you're adding all this risk to the business just to drive short-term return. This might not be in the best interest of the business. So, of course, the right response to this is to actually put in debt at a sustainable level. So many private equity firms, especially the large ones, will put in unsustainable levels of debt. Like they'll push the leverage to what they can get, the maximum limit they can get, rather than a sustainable level. For example, 2 to 3 times leverage is probably sustainable, but putting in 5, 6, 7, 8 times leverage, if you can get it, is very much high risk. But now let's focus on the benefits of debt investment. So number one, it reduces the amount of equity investors need to put in. So they can use that capital for other investments or for whatever purpose they want. They can use other people's money instead. Number two, and this is kind of linked to the first point, is that it boosts returns. So obviously, if you put less equity in and you're paying down that debt over time with cash flow, it means that you're going to get a better exit result. And we cover this in detail in our LBO modeling mini course and showing how that works as a driver, but we've also got a slide in this deck talking about this in a little bit more detail. Next, it can increase your funding capacity. So, typically overall you're going to get a better return. You're going to be able to, acquire businesses or invest in things if you've got more money. Typically the company with more money is in a much better position than one without money. So it can become a larger company, which can attract multiple arbitrage at exit. It can buy businesses, which is, again, you can average down your multiple. You can invest in growth things, which is going to supercharge your business. You can use that debt for working capital purposes or to fund international expansion, which might, double, triple, quadruple the business, right? There's just so many different things you can do with that extra funding. Next, and I've kind of covered this a little bit, it can be used for acquisitions and growth. So, acquisitions is one of the key drivers of private equity in getting those returns because, you can have one business and buy it for 6 times EBITDA as a larger business. But then once you do that, then you can buy smaller businesses at lower multiples, like 4 times, 3 times, 5 times EBITDA. And that averages down your EBITDA, but it also scales up your group EBITDA. You can get synergies between those businesses, so cut duplicate costs, which is going to boost returns. And you can get the network effect, and also when you get to exit, because you've got a much larger business, you can pull off an IPO at a certain size, you can attract a new range of investors, which might pay more money, so there's lots of benefits of doing that. And finally, which we touched on earlier, it can be used for dividend recaps, which is a way to secure returns for investors early on and de-risk investments for private equity and VC investors and turn unrealized gains into realized gains. Okay, so let's kind of talk about the key point here, which is around the key driver of returns for private equity and VC investments. So if you recall from our LBO mini course, we talked about LBOs or leverage buyout as the bread and butter of private equity. So this is how private equity and to an extent venture capital will think about investments. Fundamentally, it's how much equity are we putting in the business and how much money are we getting out of the business. And you can see in this example, if we put more debt in the business and pay it down over time with cash flows from the business, we can put less of our own equity in, and yet our equity out is going to be the same because we're essentially buying the same business, just less in, and paying down the difference of other people's money to fund it over time with cash flow. So essentially smaller money in, same number out equals bigger return. And you can see in the LBO course, we did some debt multiple sensitivity analysis. And what this means is essentially when we look at the LBO model, what would be the returns, so multiple on invested capital, and IRR, which are the two measures of performance, what would be the returns at different levels of debt leverage? And this is a multiple of EBITDA, by the way. So the less debt we put in, still a decent return in this scenario, 2.5x at IRR, but every multiple of debt that we put in the business up front, you can see that multiple invested capital is jumping about 0.25x each time, and it's really scaling up proportionally because we're putting less and less up front. Same for IRR, so you can see our IRR is starting from an already good position, 25%, and increasing dramatically, almost exponentially, the more initial debt we put in the business. So we can see that in our LBO model, if I just bring this up quickly, if we were to play around with how much debt multiple we put in, you can see how the less debt we're putting in, you can see what's happening to the charts. There's less debt to pay down, but it means we're putting more equity in up front. So zero debt, it's all equity, and we're putting a lot more in up front, but the amount we're getting out at the end is staying pretty much the same. So just have a look at those two charts, see what happens as we change those numbers. There's a little bit of movement with this amount going out simply because we're using our cash flow to pay it down during the period, and also because there's interest accumulating on that debt. That's the only reason, but it's pretty similar at the end of the day. But there's a massive difference in the amount of equity that is going up or down. You can see what's happening as we put more debt in the business. Now it's almost all debt versus initial equity. But obviously, we're limited to what the banks will lend us, and especially for a company of this size, like $1 million EBITDA, you typically only get between 2 to 3x EBITDA based on what the banks feel comfortable with. And that's why debt, especially at those very high levels initially, is one of the key drivers of returns in a LBO transaction, which is the typical private equity investment structure. So next, let's talk about dividend recapitalization. So we already went through, what it was. So it's essentially, you start off with a business like this, where you've got a mix of debt and equity in it. Or maybe you've got zero debt in it and it's all equity. So what a dividend recapitalization is, the business then takes on additional debt on the balance sheet of the company. And you can see in this example, this company now has significantly more debt as a result of this. And what we actually do with that new debt is we pay that out. So immediately, if you think about the journal entries, there's going to be debit cash on the company's balance sheet, credit debt. And then what they do is they then take that cash and then they declare it as a dividend and pay it out to all of the investors. So now what happens is there's some impact on the valuation of the company because there's more debt in it, but then there's more cash. But then the business, what it does is then pays that out to the investors, including the private equity or venture capital firm. And venture capital and private equity really love this because of these three reasons, which are the three primary purposes. So number one, it can be used as a means of exiting the investment. So let's say, you bought this business a really long time ago, it's now grown tenfold, and you need to exit it. But it's a difficult market at the moment, there's no IPOs, and maybe there's some unique elements about the business which makes it difficult to exit. For example, Green Cross in Australia, they've got an integrated model of vet clinics, retail, and all kinds of other things. So there's not many buyers in the private market of that kind of business. So in that case, Green Cross and TPG, who owns it, would want to consider a dividend recapitalization as a means of exiting their investment, or at least partially exiting their investment. So because Green Cross has grown so significantly since TPG initially invested in it, they can actually return their entire amount they put in just via a dividend recapitalization, and therefore they've effectively exited 1x their investment on the business. Next, the other way we can use a dividend recapitalization is to recover an initial investment. So again, this is similar to the Green Cross situation, but instead of exiting their entire position, what they can do is they can actually recover just the amount they've put in. And this is just a way of locking in their returns. So if you can pay out 1x your amount you put in as a dividend, you know that your investment can't go below 1x. So you can't lose money on this investment essentially. So it's a good way of de-risking it. And then you've still got your equity in the business. So if that continues to grow, you can still sell that and potentially do significantly higher. So you're locking in your downside, but keeping in your upside essentially. And then the final way that we can use a dividend recap is, or reason why we would use it is, it's basically instead of using the company's profits for dividends, you're just using it as debt instead, which might be cheaper in a low rate environment. So basically you can keep the profits in the business and you can use that for growth or whatever, but you're just using the debt to pay out the dividend instead. So that's dividend recapitalization. And the final thing that we want to go through is, just to revisit debt as what is the impact on the valuation of the business? Because even when you do a dividend recap, if you think about it, we've now got new debt on the balance sheet. And yes, the cash would offset that, so your net debt would be nil. But then you're taking that cash and paying it out, so that cash is going to disappear. So we need to consider that whenever we take out debt, it is actually reducing the purchase price or the equity value of the business. So just as a recap of this, and we'll add in the net debt video into this course as well, is how does a valuation work? Well, fundamentally, you get to your headline price, aka your enterprise value, by taking a multiple of EBITDA in most cases, by your comps multiple, and that gets you to your EV. Then below EV, your enterprise value, you do your price adjustments to get to equity value. So these price adjustments are on a dollar by dollar basis. So for example, net debt and cash. So that's going to reduce it because we're buying a business on a debt-free and cash-free basis. And there might be other adjustments below that, which might not necessarily be on a dollar for dollar. For example, working capital, typically what happens is you agree in the completion accounts what a normalized working capital amount is, and then anything above that normal, you would adjust to the purchase price. And then there might be other matters. For example, there might be CapEx, which wasn't agreed, which is an adjustment to the purchase price per the sale and purchase agreement, and various other things. So that's just a very quick recap. You can always view the M&A one-on-one training to see this all in detail. But just keep in mind that net debt does have an impact on your underlying purchase price of the business. So that's it for the introductory video on debt. Hopefully you found this useful and understand why debt is so important in investing, particularly in a private equity or a venture capital environment. Thanks for watching.